Why rent in Canada still feels broken. Rent in Canada is supposed to feel better by now. Vacancy is up, asking rents have been falling, new supply has been coming online. So why does renting still feel brutal? Why does moving still feel risky? Why does renewing a lease still feel like a negotiation you're scared to lose? And why do so many Canadians still feel like housing is the bill that decides everything else in their life? Because a softer rental market is not the same thing as an affordable one. And that is the part the headlines often skip. In this video, we're going to break down why rent in Canada can look better on paper and still feel broken in real life. Not just what changed, but why that change still hasn't reached the part of the market where most of the pain is. Let's start with a contradiction. On paper, Canada's rental market really has softened. CMHC says the average vacancy rate for purpose-built rental apartments rose to 3.1% in 2025, up from 2.2% in 2024, which put it above its 10-year average. CMHC also says rental affordability should continue improving in 2026 as higher vacancies and slower rent growth persist. Rentals.ca says average asking rent in Canada fell to $2,057 in January 2026, down to 0% year over year, and then to $2,030 in February, a 3-month low, with annual decline stretching to 17 consecutive months. That sounds like relief. And in one sense, it is. Supply really did improve. CMHC says housing starts rose 6% in 2025 to about 259,000 units, helped by record rental construction and strong completion activity in markets like Vancouver, Calgary, and Edmonton. But here is the real problem. A market can cool and still remain painfully expensive. Rentals.ca says national asking rents are still 12.9% above January 2020, even after the recent pullback. And Statistics Canada says rent in the CPI was still up 3.9% year over year in February 2026. That means the pressure has slowed, but the level where rent settled is still much higher than what many Canadians built their lives around a few years ago. That is the first reason rent still feels broken, because slowing down is not the same as going back. If a landlord stops raising rent as aggressively, that does not undo the massive increases that already happened. If new listings get a bit cheaper, that does not mean they suddenly fit your income. And if the national average looks better, that does not mean your city, your building, or your next lease feels better. That is where a lot of people feel disconnected from the data. The numbers improve first, the feeling improves later. And sometimes, it barely improves at all. Because this market is not easing equally for everyone. CMHC says, affordable units remain in high demand even as the overall market softens. Vacancy rose more in higher-end units and in new buildings, while the lower-priced part of the market stayed tighter. CMHC also says rents paid by new tenants fell in some major cities, but new tenants still paid more on average than sitting tenants. That changes the whole meaning of rent is cooling. If you are a renter looking for a newer one-bedroom in a market with lots of supply, maybe you finally have more options. But if you need a family-sized unit, need to stay close to work, or are competing for something that actually fits a normal budget, the relief can be much smaller. And that is not abstract. CMHC says national average rent paid by all tenants for a 2-bedroom purpose-built unit was $1,550 in 2025, up 5.1%, and it points out that family-sized housing remains under pressure in many places. In some cities, the cheaper segment stayed especially competitive, while larger units stayed expensive. There is another reason this still feels broken. Part of the lower average asking rent is being helped by smaller units. Rentals.ca says the average size of listings fell to 857 square feet in January 2026, down from 885 a year earlier and 943 2 years earlier. At the same time, rent per square foot still rose 1.4% year over year. So part of the reason the monthly average looks better is not because housing suddenly became cheap. It is because renters are increasingly being offered less space. That matters a lot more than it sounds. Because if your rent is slightly lower, but the apartment is smaller, that does not feel like relief. It feels like compromise. And Canadians have already done a lot of compromising. People stay with roommates longer, they delay moving out. Couples stay in units that no longer fit their life. Families avoid moving because the next lease is worse than the one they already hate. That is why the market can cool and still feel broken. Because the problem is no longer just, are rents still going up fast? The problem is whether normal life still feels possible. And for many renters, it doesn't. Now here comes the part that explains why the market softened in the first place. Yes, supply improved, but demand also cooled. CMHC says weaker rent-to-household formation and increased rental supply both contributed to softer market conditions. Statistics Canada says the number of non-permanent residents in Canada fell to 2,676,441 on the 1st of January 2026, down from a peak of 3,149,131 on October 1, 2024. That decline helped slow population growth and reduce some rental demand pressure. That sounds like balance returning to the market. But there is a catch. A market does not become healthy just because fewer people are competing. Sometimes it becomes less crowded because people gave up, doubled up, stayed home longer, or postponed moving. That is not the same as affordability being restored. It is just pressure being absorbed in a different way. And that is why this still feels fragile. Because some of the relief came from weaker demand, not from the system finally becoming affordable for ordinary people. And fragility matters because the future is not fully fixed either. CMHC says rental affordability should continue improving in 2026, but it also says housing starts are expected to slow in 2026 and decline more meaningfully in 2027 and 2028. It also warns that lower condominium pre-sales will limit new condo construction over the next 3 years. So even though today's market is softer, part of tomorrow's supply pipeline still looks weaker. That is one of the biggest corrections needed in this conversation. The story is not, Canada solved rent. The story is, Canada moved from peak rental panic to a softer market that is still expensive and still structurally uneven. That is a very different thing. And the broader economy makes that even harder to feel. The Bank of Canada held its policy rate at 2.25% on the 18th of March 2026, and warned that war in the Middle East has increased volatility in global energy prices and financial markets. The bank also said transportation bottlenecks tied to the effective closure of the Strait of Hormuz could affect other commodities. In other words, even though rates are well below their peak, the economy is still dealing with uncertainty, tighter conditions, and external shocks that keep households cautious. That matters for renters too, because rent is not experienced in isolation. If housing already takes too much of your paycheck, then groceries feel worse, commuting feels worse, saving money feels impossible, and even basic life decisions start to feel delayed. And the rest of the cost of living data supports that feeling. Statistics Canada says headline inflation was 1.8% in February 2026, but food purchased from stores was still up 4.1% year-over-year, and food purchased from restaurants was up 7.8%. So even if rent pressure is cooler than before, renters are still living in an economy where other essentials remain heavy. That is why rent still feels broken, not because nothing changed, but because what changed still has not restored stability. The pressure is lower than at the peak, but the baseline is still too high. The market is looser, but not loose where everyone needs it most. Some units are cheaper, but often smaller. Demand cooled, but not always for good reasons. And future supply still carries risk. So what is the real answer to the question? Why does rent in Canada still feel broken? Because lower rent growth is not the same as affordable housing. Because averages improve faster than everyday life does. Because the part of the market that softened most is not always the part ordinary renters depend on most. And because housing is not just another price, it is the bill that decides what kind of life you're allowed to have after you pay it. So yes, the market is better than it was at peak panic. But until rent stops forcing people into smaller spaces, delayed plans, and permanent budget anxiety, it will keep feeling broken even when the charts look better. If that's what renting feels like in your city, you're not imagining it. The market may be softer, but for a lot of Canadians, relief is still not the same thing as security.